Hi and welcome. I'm Steve Johnson, Chief Investment Officer at Forager Funds, and thank you very much for joining today's webinar. There's a lot of noise out there in the world at the moment with central banks raising interest rates, inflation seemingly out of control, the UK government also seemingly out of control, and wars around the world. It's a very, very noisy environment, and we've spent a lot of time talking about that and writing about it over the past 12 months. Today I really wanted to get back to digging into some stocks though and giving you a bit more of an insight into our investment process. We spent some time on this at our recent roadshow, and you can go back and watch that video on YouTube if you wish, where we talked about our valuation process. But I touched on a topic there that's really, really important to me, and that's that why is more important than what. We do value businesses, and every stock that's in our portfolio will have a valuation model behind it. But I'm most intrigued when it comes to good investments about understanding why something is selling cheap as much as what it's actually worth. And with a few stock examples from our current portfolios in both our International Shares Fund and Australian Shares Fund, we're going to dig deeper into what that means today. Before we kick off, today's webinar is general advice only. You should not be just buying the stocks that we're talking about here today. You need to take your own personal circumstances into account and seek advice where necessary. And we will particularly be talking about specific stocks, so that most definitely applies today. This really summarizes why stocks get cheap, or why you're able to make investments that give you above market returns over time. There's really one of two or both of these things going on. You either have a differentiated view into the future of a business, how much cash and profit it's going to generate, where you think that is going to be substantially more than what the market or other investors think, and you have a good reason for that, and that turns out to be true. And the other side of this slide is what we call human emotion factor into markets. So you don't necessarily know more about a business, but you're taking advantage of other investors' panic and disarray in times of market madness. It's a really good book on the right-hand side of this slide called The Madness of Crowds, and it's worth a read if you haven't read that one. But that's really looking for this behavior out there of people panicking and giving you opportunities to buy investments at particularly attractive prices. We're going to work through each of these two categories with some examples today. But what are we talking about when we're talking about a differentiated thesis? Well, as I already said, it's a business that is selling for substantially less than we think it is worth, but where we think it's worth more than the current market price because we know something about it that the rest of the market doesn't. We either understand that a business is going to grow more than the market thinks, or that it's going to generate higher margins or higher profits than the market thinks over time. And we come up with these theses through thinking about businesses differently than the standard model that's out there. That's wide and varied sources of information, finding your information from places other than broker reports. It's having a broad range of mental models, and we will talk more about what we mean there today. But the standard market model out there is, well, a company is earning X today, and I think it's going to grow at Y, therefore it will be earning a certain amount in future. There are lots of different ways for companies to evolve over time, and ways in which those earnings can be substantially different from people's expectations here today. And that's always just asking what might be wrong with the market consensus. I've put a quote up the top here today. It ain't what you know that gets you into trouble, it's what you know for sure that just ain't so, by Mark Twain. So whenever there is a really, really strong consensus view about an industry dying, or an industry that's going to grow forever, or a particular business being a good business or a bad business, it's always worth thinking about what the contrarian opinion might be there. It's not always going to be right. In fact, it's probably more often than not going to be right. But that's where the great opportunities are. And then on the right-hand side here, I've talked about thinking probabilistically. And this is sometimes investing in stocks where the most likely scenario, the most likely thing that you think that is going to happen, is consistent with what the market thinks, but where you think there is a skew of potential outcomes or potential futures that are different from what people are currently thinking about, and where some of those potential futures result in substantially outsized returns. Again, there's a little bit of this in what we're going to talk about today, but you'll find that most business analyses just focus on what the most likely outcome is. And sometimes, whether it be a takeover or an asset sale or some sort of option play for a business where You might make 5 times your money if something goes well. You might lose it all if it goes badly, but where that trade-off is something that adds up to a good investment for you. It's what I call thinking probabilistically about the future. The other side of that first chart was talking about a dysfunctional market. You're probably pretty familiar with us getting excited when things get dysfunctional out there. What sort of things are you looking for? Well, forced selling is an obvious one. That can be because of fund redemptions, because of people having leverage or margin debt that they need to sell, or just widespread panic. It can also be sector or business disdain. So we're seeing a lot of ESG related divestments at the moment, for example. That can create opportunities of forced selling out there in the market. It's really important that you recognize that you're probably not going to feel great in times of market distress. You're going to be reading bearish headlines in the paper. You're going to be seeing broker downgrades of stocks that you own. You're probably feeling pretty downbeat about the future itself. You don't get market turmoil without reason and cause and emotion, and you're probably going to be feeling that emotion too. We're starting to see a lot more of this behavior, particularly at the small cap end of the market at the moment. Before we get into the stock specifics, I did just want to throw this slide in quickly again and discuss it. I think it's been a really important improvement to the way I've run portfolios over the past 4 or 5 years. We are running concentrated portfolios of ideas, and they are stocks where we think we've got a differentiated opinion, and I think those ideas are rare. You need to run a fairly concentrated portfolio to make the most of those opportunities when they do come along. But it is important to put those ideas together into a portfolio that has liquidity, resilience, and diversity. It's these characteristics that really allow us to take advantage of market turmoil, and it means when you get one of those ideas wrong, it's not going to kill the future returns of the portfolio. These aspects are really important attributes on top of the stock-specific stuff that we are going to talk about today. Okay, I'm going to bring Gareth and Harvey in now, and we're going to discuss some stuff to do with the ideas in the International Fund, where we're putting this theory into practice right now. Just give us a moment to get them into the studio. Hi and welcome back. I'm joined now by International Fund Portfolio Manager Harvey Magotti on my right. Hi Harvey.
Hello.
And Co-Portfolio Manager Gareth Brown on my left.
Hello.
How are you, gents?
Very good, thanks. Yeah.
Thanks for joining us today. For those not familiar with the fund, this is a portfolio of 20 to 40 of our best ideas from around the world. The two guys sitting next to me are responsible for finding lots of them, and they're capably helped by Chloe Stokes, who's a senior analyst on this portfolio. Harvey, I want to touch on an historical example for each portfolio and a couple of current ones. On the historical front, Celsius is our most successful investment ever, and I thought it'd be a great place to start in terms of what we're looking for when we're trying to find a differentiated thesis. Yeah. What was it that you saw in this business 3 years ago?
Yeah. Well, look, we saw a very attractively valued business that was growing 20-30% year on year back then. That, definitely had a bit of hairs, but again, growing nicely. They're primarily selling energy drinks through, fitness centers, gyms, and so forth, and also online through Amazon. They had very limited retail presence itself at that point, but the story was that was going to expand. So that's where the starting point was here.
Yeah, and the share price had gone nowhere for a really long time prior to us investing in it. This growth had recently started to take off. There were a couple of short reports floating around and a few concerns. How did you get comfortable with that?
Yeah, no, there definitely were, and it was part of the reason why the stock was probably attractively valued. We did a lot of digging into a number of the issues. We got comfortable with many of them. Some remained question marks for us, but we decided that the upside here, if things go right, is just so tremendous that it's worth taking on some of these unknowns or risks that we saw there.
Yeah, it's a really important distinction, I think, between us and a lot of other funds out there. A lot of people do have a checklist, and there's nothing wrong with it, but they want to tick every box before they'll invest in a stock. We're constantly weighing up the price, the value, and some of the concerns, and it's actually pretty rare for us to find something that's screamingly cheap without concerns. There's usually a reason for it, and we're trying to dig into whether those reasons justify the discount or not. What were you looking for here in terms of proving up your investment thesis?
Yeah, well, when you look at the space, there have been some tremendous examples historically of businesses that, if they grow well in the space, they tend to generate very strong margins through time, and the shareholder returns can be phenomenal. Monster's a great example. Over 2 decades of just amazing share price appreciation, great growth, great margin expansion. People have made a lot of money on that stock. Another example in the UK is Fevertree. They sell carbonated drinks, but that was a tremendous compounding stock for many, many years, because if you get the sales, it doesn't cost you a lot to produce the products necessarily, and a lot of it drops through to the bottom line. So profit growth can be exponential.
Yep. So in this particular case, what did you need to make that initial purchase price stack up?
Yeah.
Like you said, it's carbonated water. The cost of the product is really really low, but getting that market, there's thousands of people trying to do it. That's right. Exactly that reason. Getting that market penetration 100%. Is difficult.
Everyone always tries to start consumer CPG and consumer businesses. You see them come and go on a weekly basis sometimes. And energy drink category has been a popular one because it's a very high margin and very large market size. So what we did see is a 10% market share on Amazon, and the thesis there was, if they can penetrate the retail channel to even a small percentage point of what that market share on Amazon is, you're going to make a lot of money in this stock. So all we really needed was them to go from 1% market share overall to 2 or 3. And all that required is penetrating some of the stores in the US, some of the convenience stores, and some of the larger chains such as Target and whatnot. So that's what we needed, and that's what we were hoping for.
What have you seen over the past 3 years in terms of revenue growth relative to your original expectations, and then importantly on the margin side of things as well?
Yeah, well, all we required for the business case to stack up was continued growth of 20 to 30% for the next couple of years. The business last year grew 200%. It's been phenomenal. People love their product. As they moved into the stores, more and more consumers started seeing it, started using it, and they've been taking a significant share. They're around 4% overall market share in the US now, which is phenomenal from 1%, a few years ago. And just to give you a sense, when we invested in the business, the market cap was around 400 million. They're currently generating, this year expected to generate 700 million of sales and 50 million of operating profit. So it's very clear why the share price has gone up that much. It was just too cheap to start with, and they really have executed better than expected.
Yeah, we like to lay out these markers for what's going to make an investment successful at the time that we invest in it. It almost never plays out exactly like we hope. Sometimes that's worse, and it's really important to recognise that, cut your valuation, potentially cut the investment. Sometimes it's better, and it's really important to recognise that too, and make the most out of those things that do work out better than you hope. The share price is up 20-fold here. Where do we sit today?
Yeah. Well, the nice part is that some of our initial concerns have been alleviated. The company did swap auditor from a small guy in Boca Raton to a more reputable provider. That was a tick in the box on the positive side. A new CFO came in that had a lot more experience in the space. Another big positive for us. There were question marks around some of the management team there for us initially and whether they can execute. So all these things are positive. The business is still growing really well. Pepsi just took a decently sized stake in the company. They're going to help distribute their products even further. So I think that the future looks really good. But the share price is now priced more accordingly. People understand it. It's covered by more bulge bracket brokers. And what that results in is a much more fair price. So while we have gone in and out of the position a number of times over the last 2 years, and it's been one of our more successful trading examples as well as overall investments, we've just about exited the position now, especially given that the stock actually doubled since the lows this year already. It's been one of the outperformers, and we're seeing some really tremendous opportunities in the market out there. Stocks down 50-60%, where the multi-year story is just as good as it was 2 years ago, and there's perhaps better uses of the capital at the moment.
Yeah. A lot of people often say to me, why would you sell a stock that is going well and it's doing everything you'd hoped it's done? And the simple answer is, well, that is now the consensus view, and we are looking for differentiated investment theses, and that can be fully reflected in a share price at some point in time, and it's time to move on. Gareth, from one that is fully played out for us to something that is earlier days, but where we are collecting some evidence, I wanted to talk a bit more about Flutter. You did talk about it at the roadshow, so we don't need to go into too many details about the actual business here, but a really quick summary of what it does first.
Firstly, an apology for my voice, everyone. Flutter's a global giant in online sports betting and iGaming. Of chief interest to us is its market-leading position in America, where it operates under the FanDuel brand. The American market is extremely large already, but still very nascent. There was no legal online betting in the US just 4 years ago. We had the first states open up 4 years ago, and we've had a progression of states since. And FanDuel is the market leader in the US.
Yeah, you used the word giant there, and then you talk about US sports betting, which you're seeing a lot of hype about. Those sorts of things don't normally go in the same sentence for me as differentiated thesis. What are you seeing here that you think makes this cheap?
Yeah, it's a little unusual in that this is a situation where scale is the edge. I think our chief thesis here is around scale of that US business, and a pattern we've seen elsewhere, which is that if you're the market leader with a 40% share, you're worth a hell of a lot more than the second tier player with a 20% share, or a hell of a lot more than double them. The stock market doesn't seem to have grasped that yet. Analysts love to use and abuse the term flywheel, but I think it's really appropriate here. And if you had to take that flywheel down to its most fundamental level, it's a marketing edge. We've seen it time and again that the leader can spend the most absolute dollars attracting customers while having that marketing budget be a smaller percentage of their revenue than the number 2 and the number 3 player. Our thesis, which is increasingly being proven, is that FanDuel is going to be the first to profitability, that it will be the market leader in each state, and over time it will increasingly build its efficiency around marketing so that it's much more efficient at attracting new customers than anyone else in the industry.
So unlike Celsius, very early days for this investment. You touched on a couple of metrics there, but what are you really looking for here in terms of key things to prove that you're right and the current market price is wrong?
Just total growth here. The first thing we're looking at the highest level is new legalizations of new states. So we had New York and Louisiana come on earlier this year. Kansas just opened a few months ago. We have Ohio and Massachusetts opening up towards the end of the year, potentially Maryland before the Super Bowl. And you look at a state like Ohio, most Australians couldn't have pointed to Ohio on a map. It's got nearly 12 million people. It's almost half in Australia. So, these are big markets where FanDuel is likely to be the market leader and it'll grow their business quickly. The second thing I'm looking for is how the states that have been established a bit longer, how they mature. Is revenue still growing really quickly in year 1, year 2, year 4? And, the answer for the most part is yes. And then the last thing we're trying to do here is understand the profitability piece. FanDuel announced its first quarterly profit in Q2 this year, just gone. It will announce its first yearly profit next year in 2023. But are there additional insights we can glean by looking at state-level data? We have 10 states now that are profitable for the firm. We know that the EBITDA margins in Jersey, which was the first state they opened, is now 17%. We know from way that's trajectories managed and what we've seen elsewhere, probably we're looking at 30% plus margins at some stage. And then the last piece that I'm really interested in is how the competition is developing as well. I expect that sort of gap between FanDuel and the number 2 and number 3 player to widen over time, and I think that's important we see that gap develop.
Yep, and collecting some nice early evidence for those things. When I look at your valuation of this business, you've gone UK, Australia, some bit of the rest of the world, relatively mature businesses. I can put them on a multiple of their earnings. And then this US business, it's not currently making a profit, but I think it's going to be worth a lot of money down the track. Put all of those things together and it adds up to a lot more than the current share price. Yeah. I'm often a real skeptic of some of the parts valuations because they never actually translate to cash that comes out to shareholders. What are you going to see here at a group level that's going to make this look obviously cheap to people down the track?
I think that skepticism is warranted generally, but this is not a traditional conglomerate. It's not managed by the third or fourth generation of the family and they own a gas tanker and a shopping centre. This is a an online sports betting juggernaut. This company has used and developed methods over decades here that they are now using to grow very, very rapidly in the biggest sports betting market in the world. You can use a whole company DCF going out 20 years, and you're going to get to the same number. My sum of the parts valuations are effectively 3 or 4 mini DCFs doing the same thing. What's important to understand here is over time. So the first thing is that US is going to, massively support fast growth from this whole business for a long period of time. And secondly, understanding that these things become cash flow machines as they mature, and that's not wild speculation. We've seen it in the UK, we've seen it in Australia, we're seeing it increasingly in individual states in the US, and it will eventually happen for the whole business as well.
Yeah, so we're expecting here a few years down the track a business that's trading at a very sensible multiple of whole group earnings, and particularly because of that US part here still growing quite nicely, although in Australia and the UK it has been a growth business for decades rather than just a few years. Okay, so we've owned that stock for maybe a year now. Would it be coming up to a year? Not even 10 months or so. I want to talk last about one that we've just re-added to the portfolio, and the name of the company is Tektronic. We've owned it before. What does it do, Harvey?
Yeah, well, many of you may not be familiar with the name Tektronic, but I'm sure a few of you have seen some of the products that they own. Milwaukee, Ryobi, some home improvement tool brands that you'll see in various stores in Australia and around the world.
Yeah, so actually for a company that you're not familiar with, some very, very familiar brand names out there and some very popular ones, which is, you'll come to that in a moment, but what's the big setup here in terms of why this is currently selling at a cheap price?
Yeah, I mean, there are a few reasons here. One is that it's an orphan stock. The business is largely based in the US, and yet it's listed in Hong Kong. That kind of always means that some U.S. investors can't invest in it, and so forth and so on. The returns, however, have been wonderful for the last decade. The stock's been fabulous. It has one of the strongest management teams in the space, and we really like the business. The share price is also a combination of a few things that people don't really understand about the business itself, I think. Market selling anything that's exposed to U.S. housing or U.S. kind of residential home improvements. Understandably so, mortgage rates are up and so forth, but the valuation of this business has helped over the past few months. We saw that as a great entry point into a company that over a long term has gained market share, we think will continue to gain market share, and has expanded margins very, very nicely and consistently every year, and they have a plan to continue to do so. This business is extremely focused on R&D and technological innovations. They're one of the first players to move into battery power tools. Most people now still make the cordless ones or gas powered ones, more polluting, more energy consuming, and so forth. So first mover there. Milwaukee brands are growing at 25% year on year in a market that generally grows low to mid single digits. That just shows how much people like the business and the innovative products that they're bringing to the market. So as they continue to innovate, as they continue to spend R&D and outspend their peers, these market shares should be set to continue. I think the other interesting part of the business is that they constantly launch new products. They almost create a little new end market. A tool for something that used to be done, that could only be done in a workshop, can now be handheld and is powered by a battery. That kind of creates a little bit of a market on its own right. So their addressable market and the dollars that are available to them keeps expanding, which is another thing we like a lot.
Yeah, it's a market at the moment where there's a lot of thematic-based selling of stocks.
Yes,
anything, like you said, consumer-related, housing-related has been sold off. And from what I can gather here, you're really looking for some structural winners within that, and this is probably a pretty good example of that. What are you looking for here to monitor whether you're right or wrong about that over the next few years?
Yeah. Well, the first part I want to mention is that we think the margins will continue to expand and the market share gains will continue, as I mentioned. This should result in solid returns on the investment over a multi-year period, irrespective of any near-term macroeconomic weakness, downturn in consumer over the next year or whatever else may come. A lot of this feels very priced into the shares. The stock is actually trading at a 7-year low in terms of multiple. And it's not on massively extended earnings that kind of quadrupled because of COVID or something. That's not the case. we also feel the market's underappreciating the company's exposure to non-residential construction. This is a space, and particularly in the US where you had some heavier lockdowns, where there's a lot of pent-up demand. A lot of public projects and things were pushed out for a number of years now and are finally restarting this year. Don't forget that the US only exited lockdowns earlier this year, so things took time to restart. So there's some pent-up demand there. There's also a big US fiscal stimulus package that is helping on the infrastructure and public spend side. So there's some tailwinds there for parts of the business that I think people are not quite appreciating, because they're just taking a blanket view that anything exposed to residential construction should just be sold for now.
I like to call that time horizon arbitrage almost, right? If you're willing to look out 5 years, there's probably actually not that many people that disagree with you about some of the qualities and characteristics of this business, and that they're probably going to take market share. It might not be widely known, but there's plenty of people that have got that view, but they don't want to own the stock because they're worried about the short term rather than thinking through the long term. And quite a bit of that going in the portfolio at the moment, but a great stock to have back into the fund, and one we've followed and monitored for quite some time. So interesting to see how that thesis unfolds over the coming years. Well, thank you, gents. That's been great. We'll move on to the Aussie fund now, and just give us a moment to move these two guys out, and we'll bring Alex Chevalev in. Thanks for waiting. I'm joined by Alex Chevalev, Senior Analyst on our Australian fund, to talk a few Australian stocks. This is our original fund at Intelligent Investor, invests in Australian and New Zealand listed businesses, and the fund itself is actually listed on the ASX under the ticker FOR. Similar to what we touched on in the International Fund, a concentrated portfolio of our best ideas here in Australia. Alex, I'll come to you in a moment, but for our historical example here, I wanted to touch on a stock that we owned quite some time ago. Because of the length of this fund, we've got quite a few good case studies, but I think this is one of the best of exactly what we're trying to do here in terms of having a differentiated thesis, but then having that thesis turn up in some really simple metrics for your stock. And my historical example is Jumbo Interactive. Some of you might be familiar with it now. It's quite a large company that sells online lottery tickets here in Australia. It wasn't such a large company back in 2012. The company's share price was $2 when we first invested in it, and subsequently fell to less than $1 per share. But we had a thesis here that its Australian lotteries business was worth dramatically more than that share price alone, and it was off overseas trying to build businesses in Germany and the US, on which it was losing quite a bit of money. So the thesis was either those overseas businesses are going to be more valuable, or they do something about it, and this Australian business that they own, which has some wonderful qualities and cash flow generation ability, is going to show through. As the share price hit 90 cents after the losses in Germany increased, the company had almost half of its market capitalisation in cash and franking credits. And I went up to Brisbane to see Mike Verwerker, who's the founder and runner of this business, and he was extremely perplexed about why the share price was where it was at. And this is often the case when there's a lot of hidden value in a company. Management will have an idea about what it's worth and are upset about where the share price is at. But Mike was really perplexed. He's like, we've got this business that's making all this money and we've got cash in the bank, and I don't understand what everyone's upset about. And I said to him, Mike, just look at the overall picture here. Your whole company is trading on 40 times earnings because you're losing everything that you're making in Australia over in Germany. And to his credit, he very quickly shut down that German business. They shut down the US operations, and the qualities of the Australian business started to shine through. And you can see what's happened with the share price over the subsequent years there because of that very, very simple change. So the idea here in terms of a differentiated thesis was what we call a divisional split. So we're valuing a part of the business at more than the current share price, and that is being hidden by losses somewhere else in the business. And this is probably the best case study I've had of that thesis really working out and turning up in the share price. We sold our shares here at around $4.50 per share and left a lot of money on the table, as you can see from the share price run. But if you look at this stock now, it's currently paying about 40 cents per annum in fully franked dividends. And one thing I really like to focus on in terms of determining whether a thesis was correct or not is whether it's actually generating the cash flow that you hoped for at the time you bought it. Yes, the share price appreciation has been great, but if you sit there and say, well, we bought it for $2 a share, would I be happy just sitting there collecting 40 cents per annum of fully franked dividends? You'd be pretty happy with that as an investment. So a great historical case study of what we're trying to do. And we'll turn now to a couple of current ones. One where we've got a fair bit of evidence and a bit of history with, and then we'll turn to a newer one. But let's start with RPM Global. Alex, it's a stock that will be familiar to a lot of our longer term investors because we have owned it for some time. But can you give us a quick setup here 5 years ago or 3 years ago rather than today?
That's right, Steve. So RPM Global, yes, it has been in the portfolio for some time. It's the largest position in the Australian Shares Fund at the moment. It's a company that provides software to mining companies, and some of their products are actually mainstays of the industry. So key product AMS for the maintenance of equipment, sort of an industry standard. So they've done, the products here are very ingrained with the operations of the miner. Now, a couple of years ago, the business decided to shift the way it charges its customers. So we're talking about an upfront model, a perpetual large upfront fee with small annual fees, going to a subscription model where those annual fees are charged once a year for a reasonably larger amount. That, of course, hits your shorter term profitability and makes the business look much less likely to grow than it actually had been doing and continues to do. The other very interesting thing here is we've got a managing director, Richard Matthews, who's done this before. He's built up quite a business here, and he's done it historically in a couple of other businesses where he's built them up and then subsequently sold them off.
I talked about mental models earlier in the presentation for coming up with differentiated theses. And this is one of my favourite and has been one of our most successful over the past few years because you don't really need to know a lot different about the business. It's just that the way it's reporting its earnings is masking what's actually going on in terms of the true economics of the value that's been created. You could have made money out of this model shift even in mega cap land, Adobe, Autodesk, big businesses like that went through the same shift from 5-year licenses to ongoing annual licenses. Looked like they weren't growing for a number of years while that was happening and traded at multiples that reflected that and have now made lots of money over the past few years. We've owned this stock for some time now. How is it playing out as we sit here today?
That's right. So the company has overachieved in terms of its sales. So last year they added about $11 million of new annual subscription sales. That's a great result and higher than we would have expected a couple of years ago. To go alongside that, and partly to compensate the salespeople that have done such a good job selling that software, costs have actually tracked somewhat higher than we expected as well. But the interesting part here is this year in FY23, the business has said that that cost growth will slow while the revenue growth continues. So next year we're going to see a tripling in EBITDA, which is really starting to show that really strong operating leverage that the business has. So we've doubled our money here already, and we think over time it will become a little bit more obvious because that DCF valuation and the multiples-based valuation will really start to come together.
Yeah, so 3 years ago we had a thesis here that we could see this valley of change coming through, and it's about now and the next couple of years where you really see that convergence between what's been happening 3 years ago turning up in the financial statements as earnings that everybody is going to see. And I think when this stock is trading on a very low multiple of those earnings, it's going to become obvious to more and more people what the stock is worth. You touched earlier in the commentary here about Richard Matthews, his history with selling businesses. When you're thinking about the valuation of this company, how do you think about that takeover potential aspect of it?
By and large, as upside to a case of continuing to hold this business. So if we hold it through to next year, the business would be trading at 14 times earnings and an 8% free cash flow yield. For a business of its quality, growth potential, that is a very good valuation starting point. So just holding the business, we're likely to make quite a lot of money there as well. Now, it helps that two of its larger competitors have recently been bought out at valuations that imply for RPM 2 to 2.5 times the current share price. And we think with Richard Matthews' background, we're more likely than not to see an offer like that materialise.
Yeah, and I think he's probably as well waiting for this transition period to be over so that the purchaser is also seeing the growth and the cash flow in the business and prepared to pay for that. So a really interesting couple of years ahead for that business, and I think we're either going to be right or wrong over the next few years and know it. We've got a lot of evidence that it is headed in the right direction, but it doesn't feel like one that's still got 5 years ahead of it in terms of that thesis being proven up. One that might take a bit more time, or certainly at the moment, I think where the value is a little bit more hidden. I wanted to finish with our tourism holdings and Apollo, two camper van companies that we own shares in, one listed in Australia, one listed in New Zealand, and combined these are actually the largest investment that we have in the fund. Can you start with the setup here when we originally invested in these companies?
Well, that's right. So just by a bit of background, both THL and Apollo, they're operators of recreational vehicles. So they build or buy these vehicles, they rent them out mostly to tourists, and then they sell them at the end of their useful life to the company as a second-hand RV sale. Now, we bought these businesses independently when investors were assuming a pretty dire situation for the industry as a whole, and it's actually been really pleasing to see that during COVID, the resilience of both of these businesses has been very significant, and they have not had a need to raise equity capital, whereas a lot of other tourism-based businesses have had to do exactly that.
It's been a really interesting model from a balance sheet perspective, this one, and I think any business that's in a cyclical industry like tourism, and when you're buying it going to something like COVID, where we certainly added to these stocks in the full knowledge that borders were going to be closed for some time. What gave you the confidence here that they were going to be resilient?
Well, one of the interesting elements here is as the number of tourists declined, you actually had a lot of spare capacity in your existing fleet. So these recreational vehicles were then able to be sold as second-hand vehicles into a market that was quite receptive of them as people bought more of these vehicles for their own private trips. So that ended up deleveraging the balance sheet quite sharply for both businesses and giving them capital right at the time they actually needed it.
Yeah, and go back and look at the cash flow statements for both of these companies. It's a really interesting case study in shrinking and throwing off lots of cash while you do it. Most businesses, I would say, are the opposite. They tend to require capital when they shrink, and it's something to be really careful of in a cyclical industry. You saw with both Flight Centre and Webjet, for example, because they collect everyone's money up front, and as the business slowed down, they weren't collecting money up front, but they still had all their expenses coming in. They were businesses that required two very big capital raises. They've passed that test with flying colours, generated cash flow. The businesses are now back growing, but in December of last year, they announced a merger with each other, which has really added something to what you think the combination is worth.
That's right. Well, look, this is one of the most exciting mergers at the moment in the ASX. There are huge benefits to bringing these two businesses together. So firstly, the synergies. There's $17 to $19 million of NZ dollar synergies here. That is about 2/3 of the profitability of Apollo standalone. So really, these businesses fit together very well, whether that's on the build and buy side, on the rental side, or on the subsequent sales side of the business. What you end up with here is a very large global business. You end up with significant market shares in Australia and New Zealand. You end up with Apollo's Canadian business merged with THL's US business, and both companies have a presence in Europe that they're aiming to grow.
You've got Webjet and Flight Centre, at least until recently, recovered back to pre-COVID valuations as everyone's anticipating a recovery in travel. Why is it that this combination or these two stocks have been somewhat left behind?
Well, I think the Flight Centre and the Webjet side of things are easier, they're more liquid, more straightforward recovery cases. In THL and Apollo's case, you had a little bit of complexity. So pre-COVID, we had fires in Australia that reduced profitability. We had a poor US sales market, made it a little bit more difficult to gauge what pre-COVID profitability actually was. Up until last week, you actually had the competition authorities that were still looking into whether the merger would proceed. That has now cleared and allowed the businesses to continue along their merged path. And standalone, the businesses are quite small in a market cap sense, illiquid, and especially in THL's case, listed in New Zealand, which is hard for some investors to get access to from Australia.
Okay, so lots of moving parts here. When does it become obvious that this business combined is cheap?
So into the early part of next year, we are going to see a combination of these businesses. The company, so THL, New Zealand listed, will become an ASX listed company as well. We'll have a dual listing, which will improve the likelihood that other investors will be able to purchase its shares. The combined market cap will be about $500 million, which is starting to get somewhat significant, with more liquidity, of course, than each individual business was, and so it'll be about $500,000 or more in daily liquidity. Now, in 2024, we should see a good, reasonably clean year, with some of the synergies, if not all, in place, with some of the return of international tourists into the country. And by 2025, we should really be at full run rate for both of those things. Now, the combination of the individual businesses and the synergies, the return of the international tourists, mean the combined business here is trading at a multiple of 6 to 7 times earnings when we go out to a full clean year.
Going to be interesting to see that unfold. Probably a couple of years here before they're printing those earnings, but it's not uncommon for the market to wake up to that earlier than it actually being reported in the financial results. Well, Alex, you can hang around for Q&A. I'll give Gareth a spell with his voice as it is and get Harvey back in. Thank you for tuning in. I hope that's given you a really good insight into what we're looking for here when it comes to differentiated thesis. Not just the valuation part of the business, but really trying to understand what the market is getting wrong and what's going to change that perception of the business, with a few interesting case studies from our current portfolios. You can type your questions into the box on your screen, and if you just give us a minute or so, we'll be set up and ready to answer them. Welcome back, and with a little break, Gareth's come good apparently, so we'll see how he goes here. Let's get stuck into some questions. First, kicking things off, a question from Michael, who wants to know what we think about the portfolios, both of them plural, value factor exposure. There's an argument that given the value growth factor divergence, this is absolutely the right time to have value factor exposure. That's what I want personally. Had expected to get that from Forager. The portfolios have performed a lot more like ARC, which is a growth ETF, than any value ETFs over the past couple of years. The commentary above suggests there's not a focus on having traditional factor exposure. So if an investor wanted value factor exposure, should they expect to get it with Forager, or do the team even think about it that way? Maybe we'll start with you, Gareth. I'd say the international fund has been the most, in terms of behaviour, correlated that way.
Just maybe another way to put this question, are we value investors, right? Just to put it into a way that everyone understands. Look, I think we've made some big mistakes in the portfolio over the last 9 or 12 months. We talked about that a lot on our roadshow. So this is not to say we got the positioning right. Having more of a bent towards defensives, some larger quality businesses, and certainly cash would have helped a lot. So it's not that we got the positioning right, but looking forward, no, I would say we're not looking for value factor, and we're not looking to be, exclusively in low price to book or low PE, or however you want to define value factor. We are looking for balance. Sometimes you can get really high quality, fast growing businesses available at, rates of return where you expect to earn 15, 20% or more per annum. If we can get that in a big liquid stock, great. If we can get it in something that's growing, great. We want to own a balance of businesses that shift the portfolio towards where we can get the highest expected risk-adjusted rates of return. And sometimes that will be in value, and other times it won't be.
Yeah, I think opportunism is a good way of putting that you should see a fairly significant skew. But I would also add, I think that value factor has become something very, very different from what I would call value investing the Warren Buffett way. Seth Klarman, lots of great value investors out there buying good businesses. I think if you want it, if you want that factor, you should buy an ETF. There's very, very cheap ways of getting exposure to low price to book, low price to earnings factors out there. In fact, you can pretty much buy the ASX and you're going to get a pretty value heavy index that's full of banks and resources companies, and is going to give you that we are really trying to buy individual businesses here that are going to outperform over time. And my focus is on making sure that we get that bit right. And that's where we're right or wrong is whether the earnings and the cash flows of these businesses that we're buying over a 4 or 5 year period stack up to what we think is an outstanding investment. Alex, this has been true in the global fund as well, but it hasn't actually mattered in our portfolios which end of the spectrum the stocks were at in terms of performance. It's all been hit pretty hard. And there's a Russell 2000 value index that's down, small cap value index that's down 25% year to date. The growth index is down 29%. Both of them have been hit hard. So in our international fund, it's been as much small cap as it has been growth. They've performed very, very similarly. Has that been true in Australia as well?
Well, I think that's right. And especially on the small cap industrial side of things, it's really been very prevalent. There were very few places to hide, apart from some larger businesses and cash in the last little while. And now what we're seeing is actually some of those companies that perhaps before may have been trading at higher multiples are now growing businesses at high single-digit multiples in the micro-cap space. So whether that's value or growth, we think they're going to make for good investments long term.
Yeah, and we've had a couple of stocks in our international portfolio. Rumble on a really good example of a stock that we bought, what we thought was 7 times earnings and now trades at 3, and the business seems to be going well. So some of that stuff that we thought was going to perform well in a shift from growth to value has not done so at that small cap end of the market.
So far.
John Woodhead says, Steve, any early indications that the market is getting closer to a lighter shade of black yet? He's referring there to my Jeremy Grantham quote about markets turning not when there's light at the end of the tunnel, but when it's a shade less black than it was the day before. I have no idea. You don't know that until after the fact, typically, John. But I will say something. We've got our quarterly reports coming out in the next few days, and all of the noise and the headlines out there is still, it's really, really horrible financial markets and things are going terribly. And you look at the 3-month returns, the ASX has been roughly flat. We actually had a pretty good quarter in the Australian fund, and thanks to some stock-specific news, and we're up 7 and a bit. International fund and index were about flat for the quarter. So you're getting a lot of noise out there at the moment. There are a lot of headlines, but you're also getting prices having up days as well as down days. Is there another leg down? I have absolutely no idea, but some interesting, I think, price behaviour, and we're seeing that at an individual stock level as well over the past few months. Gareth, one for you. California is likely to vote against legalising online betting. What's the impact of a no vote on Flutter?
So California has this version of democracy where voters get to vote on a lot of different propositions. Proposition 26 and 27 in the November elections are related to sports betting. 27 is the one that relates directly to Flutter and would give them the right to open an online sports betting business in California. The support looks pretty terrible. It's sort of sub 30%, I think, last count. That may rise in the months ahead, but it's not looking particularly good. We don't have anything specific in our valuations for California. We are reliant on more states opening over time. I would say a no vote here is not the end of sports betting for California indefinitely. It is more of a delay, perhaps a long delay. But it's not something that we are counting on. It would have been a nice addition to the valuation if it happened. That said, if California did get up, it would make FanDuel have losses for another year or two because it's a huge state, 40 million people, and that's a lot of marketing investment. So in some respects, it makes the DCF in the short term look better, but we'd be disappointed. It'd be nice to have California up, but we're not requiring it for the
investment stacks up without that pretty
Correct.
Clearly. A couple for you, Alex. You're very supportive of RPM Global. Seems to be operating cash flow negative in the last financial year, where cash flow in the past has been good. What's up, and should we be worried about that?
So it was negative for the full year. It was positive for the second half, and that's despite having a couple of clients that, subject to sign-off, paid them just after the cutoff for the financial year. I think with RPM, we've got to look forward into this year and the subsequent year as well. This year, they've said $14 million of EBITDA as guidance. That number is well supported by the growth in subscription revenue, as we've talked about, and a flattening off of the cost base. That is going to lead to significant operating and free cash flows over the next year or two.
Yeah, I think that EBITDA to cash flow conversion is something to watch really carefully over the next few years with a lot of these companies. There is stuff you can do under the line in terms of capitalizing your R&D expense and things like that. So worth keeping an eye on, but also I think I wouldn't overemphasize that 12-month period. It's definitely headed in the right direction there. Another one on some Aussie fund holdings. Can you make any comments in regards to the ability of companies in the fund such as Big Tin Can and Whisper to grow profitably in a higher interest rate environment? And then a follow-up question about National Tire and Wheel. Do we still own it? And can you make any comments on the current share price?
So we don't own National Tire and Wheel anymore. We sold it at about 90 cents to $1 range, then saw it subsequently go somewhat higher, but haven't been involved in it since that point. Continues to be on the watch list. It's a business that we've done a fair amount of work on over time. As to Whisper and Big Tin Can, I mean, the ability to grow profitably here comes from the business model itself. And for both of those businesses, we have quite a lot of evidence that as you fast forward a couple of years, as you slow the operating cost growth and allow the continuing build of revenue for those businesses, they should become free cash flow positive and continue to grow that free cash flow. At some point, those companies may make a decision, hopefully aided by talking to their investors about it, whether to do more on the growth side or a little bit less, but the difference should be marginal in terms of revenue growth.
Yeah, and I think in terms of the interest rate environment specifically, it has an impact on the wider economy. That may impact their revenues, but it's not a direct impact on their financials per se. I think the impact on the share price is more people seeing them as very long duration, long cash flow assets where that discount factor is bigger at higher interest rates. We'll come back to this, couple more Aussie fund questions, but one here, current cash levels for the international fund?
Roughly 8%. It's been that way for a little while. I think it's an important lubricant these times where we're trying to take profits on things that have done relatively well and move money into some absolute bargains. So we may get more invested at some point, but at the moment it's been a useful weapon.
Yeah, there's some ins and outs and changes in mix. There are a few new stocks in their international portfolio, also a few coming out, a couple under takeover. That's true across both portfolios where we expect that cash to come back. So no dramatic changes in cash weightings, but new opportunities and new investments coming into both funds. Question about coal stocks here. Did either of the funds consider coal stocks previously and currently? These were trading at very low multiples and are currently generating a lot of cash. You're not wrong about that. Did we miss out on these opportunities? The answer to the last bit of the question is yes. And the answer to the first bit is yes. We had a look. We do own one in the international fund, Gareth, that has done particularly well for us, but a very small weighting.
Yeah, we've owned a basket of commodities businesses and including a coal stock in there. We had a look at Thungela in South Africa that got spun off, and unfortunately didn't buy that, and that's done spectacularly well. So yeah, we've got a little bit of exposure, but it hasn't been a big bet for us at all.
And I actually had a big internal session probably 3 or 4 months ago talking about the idea and couldn't get comfortable about the sustainability of coal prices, even sort of near term, I guess. And it's been an historically very volatile asset or commodity price in particular. Any thoughts, I guess, in the current environment and with share prices have run up, doubled, New Hope, Whitehaven, those sorts of things have doubled over the past 3 or 4 months. Any thoughts? We don't own it, but any thoughts of people that are looking at the space, thinking about it?
I mean, I think the game there is how long can prices stay up at current levels or even above. You saw New Hope in their most recent report talk about locking in very healthy, I think $400 US prices for some months to come, and those signs probably suggest that it's going to be a little bit more sustainable. You've seen the prices re-rate because of that. It is somewhat of a bifurcated market with different qualities of coal that are being shipped around the world as well, so another thing to be cautious of. And look, they are sitting on a lot of cash, and importantly, I think in this case, they are giving that cash largely back to shareholders rather than investing it in the ground again, like has historically been the case for a lot of resource companies.
Yeah, I think that long-term story here, we talked about it on our previous webinar with Harvey around ESG concerns, lack of investment in fossil fuels creating an environment for higher prices here. Like we said then, I think the preference is to not buy it when everyone's talking about that, but buy it when everyone has forgotten it. But we've certainly missed an opportunity with those big liquid Aussie stocks in our Australian fund, and I think we'd say a portfolio exposure in the international fund that we've done very well out of, but was very small.
Directionally right, magnitude wrong.
Yeah. IDX, Alex, this is a radiology stock. It's one of the largest holdings in the Australian fund now. We're expecting this to be a very defensive business, and those characteristics may be very important over the next 12 months if we are facing a recession or a more difficult environment there. And the question was just about current weakness in price and what we see in terms of the opportunity there.
Yeah, so Integral's been hit by a combination of factors. Probably one of them, most interesting ones, is the availability of staffing and labour and the cost of that staffing and labour. A couple of other factors as well. A lot of that is tied to COVID and people getting ill. Some of it has been demand, where people have gotten ill and are unable to come in for their scheduled appointments. Now, that should relieve itself over time, and the business should then start to increase its margins from a level that is quite a fair bit lower as a starting point than it was 12 and 24 months ago.
Yeah, some encouraging signs there. August Medicare data showing people starting to go back to doctors a lot more regularly. There's even, I would imagine, some catch up to be done there in terms of people that haven't had things done that needed to get done over the past 6 to 12 months. So I think as those labour issues fix themselves and people get more and more comfortable going out, and we're seeing less and less, I think, just talk and general awareness of COVID related issues, we are expecting a really strong 12 to 18 month period there. And it's a stock in the portfolio that's, I think, got those characteristics of being able to perform to its own cycle in a way. It has proven that there are cycles, in this case impacted by government legislation, but it should prove to be a business, I think, that is recovering through even a very difficult economic environment, and maybe something that is more investors are gravitating towards in that type of environment. Really quick one, Meta, Facebook price is still dropping. Are we adding to our position to reduce our cost base there?
So who was that? Meta?
Yeah.
No, we haven't been. It's obviously faced bigger challenges than we expected when we acquired this stock, earlier in the year and late last year. I think it's on notice. We're watching closely as it develops, but no, we haven't increased our weighting.
And look, it's still a really big investment in the portfolio. It's one of the top 10 largest investments in that portfolio, and there are a lot of other stocks that have come down substantially over the past 12 months as well. We talked about Tektronic, for example, and we think that mix in the portfolio of putting some different businesses together that are equally as cheap is going to bring some pretty significant benefits. Maybe we'll take this as a last question. I think we are running out of time here. Time for 2 more quick ones. What level of net inflow outflow this year in the international fund? We're modestly positive in terms of flows for the year. We'd obviously like it to be more. We do want to grow this fund over time, but given the fund performance and the environment that we're in, we are happy with that. Mostly very long-term, loyal investors in the fund, and that is important in terms of us executing on our strategy. It hasn't been significant, but it has been modestly positive financial year to date. And any comments re liquidity and discount for the listed FOR? We've been pretty active with the buyback there, Alex, keeping that discount at around the 5% to net asset value, and we intend to continue doing that. As I've said time and time again, the solution here is performance and distributions over time rather than the buyback, but we are using that buyback actively and daily at the moment to make for a more liquid market there. Okay, I think we've covered most of the questions there, and it is 1 o'clock, so we will wrap up. Thank you very much for tuning in, everyone. If we haven't got to your question, we'll get back to you on email, or if you have any further questions after this, don't be afraid to get in touch. Thanks a lot for tuning in.